Hey guys, welcome to my video. Thank you very much for watching my previous videos. Thank you very much. So I hope they were useful, especially the one about the balance sheet. And today we are going to speak about the accounting equation. So I will share my screen with you right now. Okay. I hope you guys can see my screen. Okay, so today, as I said, we are going to speak about the accounting equation. So actually, the accounting equation is the base of accounting. I would say you cannot practice accounting if you don't know um, how the accounting equation functions. So remember from the last video, accounting equation was the formula is assets equals liabilities plus owner's equity. So if you don't remember what are the assets, liabilities, owner equity, please revisit my last video. So today we are going to learn how debits and credits work. What are debits and credits? But before I even start to explain this, I want to remind you about the financial statements. We have spoken last time about some financial statements that are really mandatory to issue at the end of the month, actually at the end of the fiscal year or any time the management wants to see the financial statements. And remember, we've seen the balance sheet, which is actually the detailed version of the accounting equation. And I also said another statement, very important, is the income statement or profit and loss. Okay, we call it in English sometimes. So this statement actually is the difference between the total revenue, total income, and the total expenses. So income minus expenses equals profit, okay? And if you remember, last time we spoke about the retained earnings, which were a part of an account actually of the owner's equity. And here we come, the retained earnings is the profit that stays in the company after the dividends are paid, okay? So remember, in order to, we're gonna speak next time about the income statement, but I just want to situate you guys from time to time because everything is related. So we have actually here the retained earnings, which is an account that is under the owner's equity type of accounts, and the retained earnings were the revenues minus expenses, okay, and after the payment of the dividends, okay. So just remember those notions a little bit because we're gonna speak very briefly today about income and expenses. So the other two statements that we are going to discuss later is our cash flow statement and trial balance. Okay, so now what are the debits and credits? Okay, so any account under the big category of assets, liabilities, owner equity, revenues, expenses is represented in a T shape, okay, with the debit always on the left side and credit always on the right side. So, okay, so for example, under the assets, we said that the assets are all the or what the company owns, okay? So one example of assets are, for example, computers, okay? So if I want to account for the assets of the company, I need to have an account for any category of assets, okay? So one account would be, for example, computers. And this account is represented in a T shape, okay? And on the left side, we have debit. On the right side, we have credit. So it's always debit is always on the left, and credit is always on the right. Any other account, okay, in liability section, for example, loan to Mark B, like let's say there is a person, in my case, in my example, is the owner, one of the owners of the company. So if the company, actually this one is the loan from, so in this case, Mark, we're gonna see lend the money to his own company. So we created a liability because the company needs to reimburse Mark. It's a liability, the loan. So we represented the account in a T shape, debit on the left, credit on the right, and so on. So any account in any category here, any assets, it's a T shape. Liabilities, owner's equity accounts, okay? It is represented as a T shape. So in order, this is the way I never forget, okay, the accounting equation. There are many other ways that other people explain on the internet, how to remember the accounting equation, how to know what to debit, what to credit, okay? The way I remember it is that any account has a debit, credit, debit, credit, debit, credit, debit always on the left, credit always on the right. So any single account, okay, increases at some point. So if we buy a new laptop, then the value of the asset, laptops or computers, is going to increase. If we sell the laptop or the laptop is destroyed or whatever, then we have to remove the value of this laptop. So the value of the account decreases. So the way I remember it is that on the left side of the equation are the assets. Any asset, if it increases in value, it increases on the debit side in accounting, okay? I specify in accounting. An asset account increases on the debit side and decreases, if we want to decrease the amount in the asset account, it decreases on a credit side, okay? So if we buy a new computer, we're gonna have examples of $800, and I want to show that the computer's account increases in value, I'm gonna debit the computer account, and we're gonna see examples, okay? If I destroyed one of the computers of the company, okay, and we had 10 computers, and then one is lost, then the value of all the computers of the company decreases, so I will have to credit the computer's account if this is the case, okay? So the way I remember it is that you have the assets for any account, no matter where they are, under what category, assets, liabilities, owner's equity. They have a debit and the credit side. The assets, okay, start with debit, they increase by debit and they decrease by credit, so plus, minus. On the other part of the equation, accounting equation, then the liabilities do the opposite, okay? So they increase example of a loan from the bank, okay, if I want to take a loan, then the liabilities of the company increases. So I have to credit the account, loan from the bank or whatever is the account, whatever I call the liability account. And if I pay the loan, my debt decreases and I have to debit the account. Same thing for accounts in owner equity. For example, owner contribution, okay? So if the owner put money in his company, then I have to credit the owner contribution. And same thing for just saying, okay, because we're gonna go into details. Same thing for the revenues, but the revenues, it's actually a part of the retained earnings, if you remember, because it's only the retained earnings as an account that is part of the owner's equity. And retained earnings, as I told you, it's a whole formula being revenue minus expenses, okay? But revenues and expenses are another type of accounts that we going to find on the income statement, okay? So expenses and income, we're gonna find those type of accounts on the income statement. But if we want to remember how revenue increases, then if we think about revenue, the revenues, more revenues we have, more the owner's equity increases in value. And more expenses we have, then the owner's equity decreases, okay? So because of this, I'm just gonna tell you, but I'm gonna show you examples. The revenues, because they are positive things for the owner equity, they behave exactly like the owner equity account, owner contribution. So they increase, if the revenue increases, we credit the revenues. If the revenue decreases, then we debit the revenues. The expenses do exactly the opposite because they actually, if you have expenses, then you have less owner equity, okay? Part of the big formula of retained earnings. So the expenses decrease the owner equity. So then they behave exactly the opposite of the revenue. So that means that if expenses increases, they are going to be debited. And if the expenses decreases, they are going to be credited, okay? But this, we're gonna have examples. So for the moment, just remember this, my way of remembering the accounting equation, okay? It's debit on the left, credit on the right. And then if I don't want to forget the minus, plus, minus, plus, I will start with the plus minus for the assets. And on the right side of the equation, it's exactly the reverse, okay? So minus, plus, minus, plus, and on the left side is plus, minus. Now we go back here, and I said assets always increase on the debit side, decrease on the credit side. On the right part, okay, it's exactly the opposite. So why we say in accounting that the accounting is a double entry, okay? Because any transaction in accounting has two parts, okay? One debit and one credit. So anytime we enter a transaction, we have to debit at least an account, and we're gonna see example, and we have to credit at least an account. Now, when we are going to advance, we are going to see that we can debit in the same transactions more than one account, 2, 3 accounts, we can credit 2, 3 accounts or only one account, but the rule for the transaction to be valid, correct, is that the total amount that we debited the account is equal to the total amount that we credited the account, and we're gonna see examples, okay? So now we are going to go directly, I think, to the transactions, okay, now that we explained this. And I'm going to give you an example, okay? So the example here is that, for example, only a few, okay, examples. The owner of the company transfers $2,000 to his company, okay? So as I said, for this transaction, we are not speaking about dates, we don't go into details, okay? So this is, let's say, an electronic transfer. So as I said, we have to account those $2,000, okay? So accounting is double entry. We just cannot enter in the system just $2,000 once in the bank account. We have to debit the bank account because it's an asset, okay? The money that the company owns. We have to debit the bank account. And then on the other part, we have to credit the owner contributions. So let's say that the owner says, this is not a loan to the company, this is my contribution to the company, okay? So I'm gonna show you on the T account, but if we go here in the equation, okay? So bank account is here, we're gonna debit 2,000, and owner equity is here, we're gonna credit 2,000. So 2,000 equal 2,000. Now, if we want to go here, I give you an example, is that we're going to put in the checking account, we debited 2,000. So the checking account, okay, is in the shape of T. So we debited 2,000. And the other 2,000, we have to credit something because we always have to have a debit and a credit. And now we only have one account. So we're gonna credit the owner contributions account, which is part of the owner's equity. Okay, so on the accounting equation, debits equals credits. Okay, so the owner contributions account increased by 2,000. And the checking account at the bank increased by 2,000. So if you come back here, okay, so the assets increased by debiting and the owner's equity increases by crediting. Okay, so next example is the company buys a $800 laptop, okay? So the laptop is an asset, so we have created an account called computers, and we debit because we increase the value in the computers, 800. And we suppose that we don't go into details right now, as I said. So we paid the, let's say that we paid the laptop with a debit card. Okay, so we took the money from the checking account. So the money in the bank decreases. Okay, we took $800 from the bank and we bought the laptop, okay? So in this case, we have two assets, but we have a debit part, we have a credit part. So here we had the computers that were debited, it's an asset. Then we have to credit something, okay? And we need to credit, in our case, the checking account. We credited with 800 because we took the money from the checking account, okay? So in this case, debit equals credit, okay? So we put 800 in the laptops, we took 800, so it's 0, okay? So in this case, the transaction happened, we have a debit, we have a credit, but the transaction happened only on the left side of the equation. Okay, from some assets here we increased it in the computers, and we took off the 800 from another asset. So it's 0 here, 0 here. Debit equals credit equals 800. Then the next example is the company received a $90 monthly internet bill. Remember, they receive the bill, they didn't pay it yet. Okay, so the internet expense is $90. Okay, so we have a debit. So this is an expense for the company. As I said, okay, the expense is a type of account that we're gonna see on the income statement, profit and loss. And as I said, an expense is gonna decrease, it's gonna lower the amount of the owner's equity. So the owner's equity usually increases by the credit, but these expenses are really working against the owner equity. More expenses we have, less owner's equity. So that's why the expense account is going to behave exactly in the opposite way. It means that the expense accounts are going to increase by the debit side, okay? So if we go here, we created a T-shaped account for internet expense. So we debit the account. And guys, if you remember, so we didn't pay the invoice yet. We spoke last time about the accounts payable, and the accounts payables where the invoices are the bills that we receive, and we don't pay yet. And as long as we don't pay them, they stay in an account that it's called accounts payable. It's a liability. So then we have to credit the liability. The liability increased by $90, okay? So we know that the liability here, the liability increases on a credit, on a credit side. So that's what we have done. We have debited the expense and we have credited the accounts payable. We received the bill, we didn't pay it yet. Okay, so remember here, we debited the internet expense and we credited the accounts payable. Now, next example is that the company pays the bill, okay, the $90 bill. What is going to happen if it pays the bill? Well, the liability is going to decrease, okay? We have to remove from the accounts payable the $90 because there is no liability anymore of $90. We're gonna pay it. And then on the credit side, we're going to pay, let's say, the bill by direct deposit. Okay, we're going to take the money from our bank account. So our bank account is going to decrease. So an asset is going to decrease by the credit side. Okay. So then when we pay the bill, then we're going to debit the accounts payable. This is a liability. The liability is decreasing by debiting it. Okay. And also, what is going to decrease? It's our bank account. So it's going to decrease by crediting. So in our case, accounts payable minus 90. We don't have a liability anymore, and credit the bank account. Okay, so now if we go in our T accounts, we'll see that the accounts payable, we have to debit for $90. And also we are going to debit here our checking account in the bank because we pay the bill. So debit equal credits. Okay. So next example is Mark, which is the owner of the company, transfer $10,000, okay, into the company bank account to help the company buy a car. But this time he gives the money as a loan, okay, to his company. He wants the money back. Let's say no interest, okay? So then he's gonna transfer $10,000. The bank account is going to increase by 10,000. So the bank account is gonna be debited. And the and we're gonna credit the liability loan from Mark for $10,000. Okay. So debit equals credit. If we go in our T-shaped account, debit, we're gonna debit the checking account. Okay. Our bank account is gonna increase by 10,000. And Mark said this is a loan. Okay. So the liability of the company, okay, increases by $10,000. At some point in time, the company has to reimburse the 10,000 to Mark. Okay, so debit equals credit. Now, these are some of the examples. These are not as all the accounts. In the future classes, we're gonna speak about the what we call some control accounts, which are in these different big categories that are behaving exactly the opposite. For example, a contra account, which is in the category of assets, is going to behave exactly in the opposite way. That means that, guess what? It's going to increase on the exactly on the opposite side, but we don't go into details right now. We just want to understand debits and credits, how it works. Double entry, debit equals credit. Now, if we want to calculate, okay, how much money we have in the checking account, well, we debited the account with some money, so the amount increased. We credited the account, okay, we took some money to pay the laptop, to pay the internet bill. So we have the formula here, debits minus credits. So in the checking account here, at the end, let's say, of the month, we have $11,110. Here, zero liability, debit minus credit. Here, okay, we have the expense that we had. So we always will have the expense, it remains for the period. Here, the balance is 800. And we still have the liability to the owner, and the owner's equity is 2,000. So, guys, before we had the accounting software, this is what accountants have done. Actually, they did pages and pages of T accounts like this in order to take into account all the transactions of the company. But right now, all the exercises at the university college level we do these T accounts and we do all the exercises, as I said, in order to understand how the system functions, because otherwise you don't understand the accounting. But everything is done. We enter a transaction in the accounting system and everything is done automatically. You can see the balance in the account, okay, at the moment you can issue a balance sheet, for example. So if I go here, I just want to show you two things on QuickBooks. I want to show you that if you want to verify, I want to show you that debits equal credits always. And in QuickBooks, it's really it's very simple to look, for example, for a kind of report. I don't even have to go here in reports. I have opened a sample company in QuickBooks Online, and I'm going, for example, for a type of report, which is journal. And here are all the entries, okay? So I can take a report for what period I want. They just want to show you guys what I said. Here is a transaction, okay? And for this transaction, this company, okay, which is Long for Success, they sent an invoice to their client, okay, for some consulting services. So the invoice is sent, as I said, the invoice that is sent is not paid by the client. It stays in accounts receivable. So look, just for your information, okay, so accounts receivable, it's an asset. They debited the asset. They have to receive 1,356. And then they credited, this is an income account, okay? So the income, it's increasing the owner's equity. And there is also a tax, okay? So they owe some tax to the government. The liability is increasing by the credit. But just to show you guys that any transaction, okay, has a debit part, credit part. We have to have at least one account on debit, one account on credit. We may have one account on debit and two accounts on the credit side, or vice versa, three accounts here, one account here. The most important thing is that the total amount of the debit equals total amount of the credit, okay? And right now, and we don't have anymore the T accounts whatsoever. You know, as I showed you last time, if we take, for example, a balance sheet, you want to take this, let's say, as we did last time at the end of January, okay? Here is the balance in the accounts, okay? The accounting system calculates it automatically. The accounting system, in other words, do those T accounts and do the debits, credits, and calculate everything. The most important thing is that we have to know how to post these transactions correctly, how to post the invoices, the bills from the client, or any other activity, and then the statements are issued automatically, provided that the information is posted correctly and based on the accounting principles. So that's it, guys, for today. Thank you very much for this. I hope it was useful, and see you next time. Bye bye.